When investing in real estate, the owner must, in most cases, determine which of the two primary strategies they plan to pursue, or in simpler terms, how they will make money through rental income or property resale. The rental strategy involves purchasing real estate with the aim of generating a consistent income from tenant payments. This approach locks up capital for a very long period, measured in years or even decades, but allows for the creation of a stable cash flow. Within the rental strategy, there are also two main approaches to management: active and passive. In the active approach, the investor personally seeks clients, arranges contracts, addresses practical and legal matters, but in return they receive all the profits from the property. In the passive approach, a property management company takes care of all the work and receives a percentage of the income in exchange. With this approach, a portion of the profits goes towards paying for the company's services, but the investor gets a completely passive asset that requires no time investment. When buying real estate for rental purposes, it is crucial to focus on the payback period. You can calculate it by dividing the acquisition cost of the property by the anticipated average annual income, while also subtracting taxes and other expenses. It's essential to remember that the projected income may not always align with the real income. Even in an ideal scenario, vacancies are almost inevitable. And an unoccupied property means not only a lack of income, but typically losses as well. The rental strategy offers a lot of flexibility, as you can lease the property for short or long periods. The shorter the lease term, the higher the potential yield, but it also requires more effort and time to find tenants and interact with them. On the other hand, the resale strategy is built on a simple idea: buy low, sell high. This approach has the potential to generate significant profit over any time frame, often exceeding the rental income for the same period. For instance, you can buy a house below market price and sell it with a markup after a few weeks or months. Alternatively, you can invest in a property for many years and later reap substantial profits. The investor just needs to choose assets that align with their strategy. For comparison, 20 years ago in Thailand, you could purchase a 1,600 square meter land plot for only $500. Today, you could sell it for approximately $145,000. Consequently, the land price has increased nearly 300 times. However, substantial real estate expertise is required for resale because you need to identify properties with significant growth potential. Additionally, it's desirable for the investor to possess well-developed sales and negotiation skills to secure more favorable deals. In addition, resale involves significantly higher risks. If expectations are not met and the property cannot be sold at a higher price within the anticipated time frame, the investor will have to make a tough choice: sell at a significantly lower price than expected, or hold on to the asset for the long term. All of this makes this strategy more suited for professional real estate agents and companies rather than individual investors. However, private investors can still profit from price appreciation. One of the most popular methods is buying real estate during the construction phase or even at the project stage. Such a transaction comes with risks, but typically, after the completion of the property, it tends to appreciate in value and can be sold. Private investors often buy real estate with the expectation that the area is located in and will be improved by the authorities in the future. New job opportunities, stores, and attractions will enhance the desirability of the area and attract new residents, which will have a positive impact on local property prices. To maximize profits, one can combine the purchase for resale with a rental strategy. By acquiring real estate for several years, it can be temporarily leased to tenants who will not only cover expenses and taxes, but also increase overall income and provide a stable cash flow. When choosing between speculative and rental strategies, it's difficult to declare an absolute favorite, as each approach has its own merits. However, the speculative strategy is riskier and requires a calculated and professional approach. Therefore, novice investors should consider real estate as an asset that generates a steady income, especially since good properties typically appreciate in value over time and can be sold for a profit in the future. In this module, we've discussed two fundamental real estate investment strategies. In the next module, we'll talk about the risks associated with investing in this asset class and possible ways to mitigate them, including, perhaps most importantly, diversification.